I've been trading Forex for over 15 years, and in this video I show you everything you need to know in order to get started with Forex trading, how to understand price charts, and how to get into your first good trades. We also have a free Discord community which is just opening now. Check the link in the video description below. So very basic, Forex stands for foreign exchange market, and this means that this is a financial market to trade currencies. And now let me show you how to profit in Forex trading, how to make money in Forex, and how to get into the price charts. Luckily today there's a lot of free ways how to get charts and how to read Forex pairs. I recommend you go to TradingView, and then under products you can just go to super charts, and then this will show up. What we can do first, because we are looking at Apple now, the stock by default, we just click here on the top left and then we type in Euro USD. And this stands for the Euro US dollar foreign exchange pair. The Euro US dollar is the most commonly traded Forex pair in the world. It's the most active one. So what we see here is a so-called candlestick chart. Each bar here is a candlestick. And the candlestick shows you the price information and the price movement. If you are not familiar with trading, this is probably how you know trading charts, and this shows you whether a Forex pair or a stock or any other financial market has rising or falling prices. However, this line chart only shows you very limited information. And the line chart only gives you the price information for the end of the day. But of course, during the day, the price can often fluctuate quite a bit and it can go up and down during the day. And that's why we are using candlestick charts. Now we are on the daily time frame. You can see it here at the top left, D1. When we click on this, you can see we can change the units, and I will come back to this in a moment. But because we are on the daily chart, it means that each candlestick represents 1 day of price action. Let's look here left, and let's look at one of the green candlesticks. A green candlestick means that the price has gone up during the day. In trading terminology, we call the big rectangle part the candlestick body, and those small lines that stick out on some candlestick to the upside and to the downside, we call them candlestick wicks. The candlestick range here from the low of the wick to the high of the wick is the whole price movement during the day. So this would be the lowest observed price for the day at the low of the candlestick wick, and the top of the wick shows the highest observed price on that given day. For a candlestick, the body here, this is the solid part. The low end of the body is where the price opened for that day. So on this day, the price opened here at the low part of the body and it closed at the other part of the body. For a red candlestick, this would be the complete opposite. Here, the price opened on the solid part of the body and it closed here lower on this other solid part of the body. The candlestick wick then shows you the fluctuations. For example, for this day, what could have been happening is that you open here for the price moves up in the first few hours, then moves lower to the other extreme of the candlestick wick, and then moved a little bit higher to close here. So the candlestick shows you all of the information that you need for that day, and it's very important for price action traders that we are using candlesticks because it shows you more information than just looking at the line graphs. So then the question is, how do we actually make money in Forex trading? And there are two unique ways on how we can profit in Forex trading. The first one is going to be a little bit more obvious. And for those who have a little bit of an interest in trading or who have looked at investing in the past will understand this quite quickly. So the first way is that we can choose to buy a Forex pair, and then we are going to profit from rising prices. And this is identical to stock trading. So if you're buying Apple today and then in the future the price is rising, you are going to profit from those rising prices. So if we choose to buy the Euro US dollar Forex pair on that day, and then the price is actually indeed rising in the future, and we are closing our trade later for a higher price, we are going to make a profit. Of course, if the price would go against us and if the price would fall in the future, then we would realize a loss. I will show you in later parts in this video how we actually make those trades in our trading platform. The second way of how we can profit in Forex trading is we can profit from falling Forex prices. So let's assume that on that day, we believe that in the future, the Forex price is going to fall. In Forex trading, we call this a sell trade. We are betting on falling Forex prices. Again, I will show you this later, how to actually do this in your broker platform. So if then in the future, the price is actually indeed falling, then you can profit from those falling prices if the price at a later day is lower than what you sold it for. Of course, if the price would go higher afterwards, then you would realize a loss. This might sound a little bit more complicated than it actually is, but just stick around and I will show you how to do that in your broker platform. Now the next question is, how do we actually know whether the price is going to go up in the future or down in the future? And for that, we're going to look at price analysis, price action trading, and technical analysis. So if we want to understand price charts and better anticipate whether the price is going to go up or down in the future, we have to learn about chart phases and trend phases first. What you'll see is when you look at a price chart, you will see times where the price is going up and you will see times where the price is going down. So here on the left side, when the price was rising, we would call this an uptrend or a bullish trend. You might have heard the terms bullish and bearish in trading and investing, and this is what it refers to. Bullish means upwards trending markets. On the other hand, here on the left side, we see that the price was moving lower. Here we say that the price was in a downtrend or in a bearish market. And when we now look at those trends a little bit clearer and look into a trend, we're going to see that in a trend there are phases where the price goes up and down. And you will see that those phases alternate in a trend. And those are the building blocks of trends. They happen during uptrends, but also in downtrends where you have times where the price is going down and up and down again. We call those building blocks of those trends trend waves. So a trend wave that is going into the direction of the overall trend, we would refer to this as trend waves. So here we are in an uptrend. So this would be a trend wave, this would be a trend wave, and this would be a trend wave. In the case of a downtrend, we would say this is a trend wave here to the downside, and this is a trend wave because it's going with the trend direction, which in this case here on the right side is a downtrend. But as you can see that there are also periods where the price is going against the trend direction. So again, this is an uptrend, a bullish trend, but there are periods where the price is going against the trend direction and it's not advancing higher. We call those phases counter trend phases. Some traders will refer to this as corrective waves as well. It's the same thing. Here as well, on the right side, we're in a bearish trend, in a downtrend. And in this period here, the price moved against the downtrend. So this was a corrective phase or a corrective trend wave against the overall trend direction. A very helpful thing to keep in mind is that those counter trend waves and those corrective trend phases are usually much shorter and also not as severe as the trend waves into the trend direction. On the right side, you can see in the bearish trend, this bearish trend wave was very long, whereas this counter trend wave here was very short. Here on the left side, we see it as well. We're in the overall uptrend, the bullish trend. The bullish trend waves here are much longer than those short counter trend waves to the downside. So trends are really important in Forex trading, and we are going to learn how to anticipate trends in a moment. But there's one third thing that is important as a trader to realize, and that is that the market can also go sideways. So there will be times where the market isn't going up or it's not going down, but it's more or less trading sideways in a sometimes more or less well-defined area. So those are called ranges or sideways phases. What you'll often see is that those sideways phases are the connectors between trends. So here we have the sideways phase and the range, and it occurs after an uptrend and before a downtrend. And this is very typical to see. So you have a trending phase, then the market is pausing, and then it's reversing into the opposite direction. And those are the three phases that you need to be aware of when you're looking at charts. And those are also very common terms that you will hear time and time again. So let's come back to the question, how do we know whether the price is going to go up or down in the future? And for this, in technical analysis, we are looking for recurring price patterns and chart patterns on our price action charts. As you will notice after a while, you will see patterns that are going to look very similar, and those are going to shape over and over again on your charts. And by studying those patterns and by learning how they will play out, how they shape up, you can learn how to anticipate price movements. For example, if we are looking here at this downtrend, we can see that here in this corrective phase, this is what we will call a flag pattern in our trading or in technical analysis. Why is this a bearish flag pattern? This first downtrending phase would be considered the flag pole. So this would be the flag pole, and this is then the actual flag. And then when the price is breaking out of such a flag pattern, very often you will see that afterwards the price is going to continue fall. It's important to understand that patterns need to be found in the correct context. So you always want to look at a market and you always want to find a market that is already trending. So here we can see before the flag pattern, the price was already moving lower quite a bit. And then during the flag pattern, the price was rising a little bit, but not as strong as it was falling here previously. And then the flag pattern is a so-called continuation trend pattern. It's called a continuation trend pattern because this happens in an overall trend, and it could signal a continuation into the downtrend. There are going to be many more patterns that you can study as a Forex trader. And on my YouTube channel, I made dozens of videos over the years on those chart patterns. I will link a few in the video description below, and you can watch them as well. Now let's take a look at another pattern, and we are also going to take a closer look at the concept of time frames. So we are still on the daily chart. You can see here, this is day, and here it says 1D. So each candlestick represents 1 day. But what happens when we go to a lower time frame? And for that, I want to look into this pattern because that's going to be quite interesting on a lower time frame. Let's not forget the previous context. So here is a previous area of support. We call areas of support where the price has bounced from higher, and we call areas of resistance price levels where the price has moved into and then moved lower. It did that again here. The price moved into it and then lower. So this is what we call a resistance level, and this is what we call a support level. In trading, it's very important to look at how the price is responding to a resistance or to a support level. And you can build very great trading strategies around those key concepts of support and resistance. And a lot of those trading strategies use the concept of breakout trading. And what this means is that you draw your support and resistance level, and then you wait for the price to break such a level, and then you trade into the direction of the breakout. So I want to look into what has happened here, and we want to see how it looks on the lower time frame. So we are now on the 2-hour time frame. You can go to the 1-hour time frame, or if you want to be an intraday trader, you can go even lower. The time frame choice is quite personal. I made a podcast about this, so you can also check it out in my podcast. I will also link this in the video description below. So this is the support level that we drew on the higher time frame on the daily. That's the resistance. And this is the circled area of the breakout that I wanted to look with you in. So when we look at this, what can we see here? Let's first make this a little bit bigger, and you can do that very easily in TradingView. So we just click in the right sidebar, hold it, and then drag it up. So this helps us to zoom into the price action. So after the breakout here of the support level, what happened? What we can see is that the price has a lot of wicks, and very often you are able to connect those wicks, and if the wicks then line up and they respect the same trend line, that's what we call those diagonal lines, they're called trend lines, then you can use them in your trading. So we can see on this trend line we have 1 touch, 2 touches, and a 3rd touch point. In that case, we are talking about a valid and a confirmed trend line. For a trend line, you always want to have 2 or better 3 trend line touches. And we can also say this looks like another flag pattern here. We have seen a flag pattern on the daily time frame, and we can see flag patterns on lower time frames. You will see that patterns repeat on all time frames. They just take longer or shorter depending on which time frame you are. But in general, you can look for patterns on any time frame. So what we can then also see is that this pattern occurs after this trending push. So we have the trend phase. We also have the breakout that is occurring here that we've observed on a higher time frame. Then we have our flag pattern right here. And then on the breakout, the trend is continued. And this is what I was referring to with breakout trading. You have the breakout, you identify the trend, you know the support level is not holding, it's breaking. You have your pattern that is helping you to define the price action, and it's very important that you find those recurring patterns. Having a trading system that is based around recurring patterns is helping you to analyze those patterns and to find recurring themes. You'll be able to analyze the statistics of such patterns, and then you can find out if they're reliable enough and how to trade them to make money. So here you can see that the trend line and the flag have been broken. So this is where you could have looked for a short entry, and then afterwards the market moved lower. And if you were able to sell around here, you could have made a profit if you were able to then close the trade later. So this example connects the concepts of time frames, higher and lower time frames, and pattern trading. Now let's look at a different pattern to understand the underlying concepts. First, we need to see the trend direction and the trend context. Here, clearly, the market is in a bullish trend and it has been rising steadily over the last candles. When we look at the current price action, what we see is that we have a so-called triangle pattern. Here we can connect the highs of those price phases. So we have the high from this candle wick, the high from here, and the high from this area. And then when we look at the lows here, the moves against the trend, we can see that if we connect them, we get roughly here a triangle pattern. It's okay to cut here through the candlesticks. We just want to see the overall shape of this price pattern. So this is what we would call an ascending flat top triangle. The triangle has a flat top and the lows here are ascending. And this is a bullish continuation price pattern. If the price breaks here to the upside and if the price is able to close here on the upside, this could signal a trend continuation. And after a breakout, a trend continuation to the upside is more likely than the market moving lower. So 2 candles later, the price is now trading above the trend line. In trading, we would call this a breakout trade. And it's a breakout trend continuation trade. At that point, traders could enter a buy trade with their broker and they are anticipating that the price in the future is going to rise. And if the price is going to rise, they will make a profit. But if the price is going to fall, which is also possible because nothing works 100% in trading, and there's always a chance that the market will not do what you anticipate, then you will realize a loss. So assuming we now enter a buy trade here, and then the market is actually indeed going higher afterwards, we are going to realize a profit. So I think you can get the idea now. First, we look at the trends and the trend structure and the trend direction, and then we are trying to find those recurring patterns. As I said, there are dozens and dozens of patterns that you can study, and make sure to check the links in the video description. There's also a free ebook that I wrote over different patterns that you can study and you can download for free. For all of those information, make sure to check the link in the video description below. One thing that is very unique about Forex trading and about the Forex markets is that the Forex market is open 24 hours a day, 5 days a week. It is closed on Saturday and Sunday, but in between it's always open. Unlike the stock market, which is only open in the local hours. So you can only trade at the New York Stock Exchange when the New York Stock Exchange is actually open from the morning until the evening. But Forex, you can trade all day, every day, except for Saturday and Sundays. One thing that is important to realize in Forex is that we can divide the Forex day in different Forex sessions. And this is very important because Forex pairs will move differently at different times of the day. So the first stock market to open is Sydney. The next stock market to open is the Tokyo market. After the Tokyo market, London is going to open, and then a few hours later, New York is going to open. And what this means is, for example, when we look at the London session, is that Forex pairs and Forex currencies that are related to the European London session are going to be more active and they're going to move more. And Forex pairs that fall into this are the Euro Forex pairs and of course also the British Pound Forex pairs. During the New York session, the most active Forex pairs are going to be the ones that have the US dollar or the Canadian dollar in them. Of course, you could still trade any other Forex pair during any of the sessions, but as you will see is that the local currency is going to move most during the specific times of the day. I will put links to all of the things that I'm showing you here in the video description as well, so you can check it out for yourself. So currently you can see it's Monday, 2:30 p.m. here in European Berlin time. And you can see that currently the London market is open and the New York market is just opening. So at that point in time, it would make most sense to trade European Forex pairs, so the Euro and the Swiss franc and the British pound, and also look at US dollar or Canadian dollar Forex pairs. Underneath, you can also see that the most active trading time in a day is here, just a few hours later compared to where we are now. So this is the end of the London session and the early hours of the New York session. It's the most active trading time in the Forex market. The least active trading times, and when the price doesn't move as much, is here when the New York market is closed and only the Sydney market is open. Same here on the left side. This is the time when only the Sydney market is open, all the other stock markets are closed, and that's the least active trading time. Another important thing about Forex trading is to be aware of news. Every day there are going to be different news releases from different countries. And those news releases can impact your Forex prices quite a bit. So it's very good practice to check your news calendar once a day. So you can go to forexfactory.com and then you will get this news calendar. And this will show you the different economic news reports that are going to be scheduled on a given day or on a given week. It will show you the Forex pair that it's most likely going to be influenced and also the impact. So here red stands for high impact expected. Orange stands for medium impact expected. Here you can see the name of the specific news, CPI, and when you go here to this folder, you can get some more information. You will get the measurement, you will see what this actually means, why traders care, and you can also see some information about past results. Something that is really helpful in TradingView is when you right-click on your chart and then you go to Setting, and when you go to Events tab, you can show and tick this Economic Events box here. And then you can apply this to your charts, and then you can already see something is changing here. So when we look at those bubbles here, they show you the economic news events that are going to be expected. When we click on it, you'll see we have building permits, and because here on the left side, it is red, it's a high impact news event. Here you can see others, you can also look at past events, and then this will also show you how the price was influenced by past events. Some of the features that I'm showing you here might only be available to paid TradingView subscriptions. So if you want to unlock some of the features, you might have to sign up for a paid TradingView subscription. But you could also just check the Forex Factory news calendar for free. So now I want to show you how to actually execute a trade on your charts. And here we are now in MetaTrader 4. MetaTrader 4 is the most popular and most used Forex trading platform out there. It's very easy to use and most brokers will offer MetaTrader 4. And I will show you how to use MetaTrader 4 to execute trades. In Forex trading, we are measuring the price moves in pips. This is different from stock trading where we measure the moves in points. So let's measure here the distance from where the price currently is to here, for example, right? I will bring up the calculator and it's actually quite simple. I just want to show you one time how we calculate it, and then I will show you a shortcut. So here we can see the price on the right label is 1.06233. And on the lower side, we have 1.05576. The difference is 0.00657. We are ignoring here the last decimal because we only want to look at the ones before that. And what you can see is here we have 65. So we would say this is a difference of 65 pips in trading. And in MetaTrader to measure distances is very simple. You just go here to the crosshair, and then we are measuring the distance from this horizontal line, and we hold it and drag it to the higher line here, and then you can see 653. We are ignoring the 3, and then you see we have 65 pips, the way we also calculated it. And this is how we measure distances in Forex. And it's important that you have heard the term pips. So now let's assume for whatever reason we want to get into a long position, we want to buy the market and we want to execute a buy trade to the upside. For this section, it's not important about the analysis and why we might come to that conclusion. I just want to show you how to execute such a trade. One important thing to do in trading is that we also want to set a so-called stop loss order. So a stop loss order is an order that you can set in your broker that will automatically close your trade when the price is going against you. And this is a way to protect your account and to implement a risk management strategy. So let's assume we are going to buy around here, and then our stop loss should be here. Because when the market reaches this area, we want to be out of the market and we want to close our trade. But the question is then, how many units should we buy? What we can do is that we measure the distance from where the price currently is to the red horizontal line where our stop loss is going to be. And it's going to be 46 pips, right? We again ignore the 9, but we can round it up, so it's 46. At the same time, we can see in this trading account currently there is 1,000 euros. When you go to Google and you search for Forex position sizing calculator, you will find a lot of links. I will post the link to this baby pips Forex position sizing calculator, which is very handy. So we choose our current currency and we have seen this is euro. Then we have seen we have roughly 1,000 euro in there. And assuming we want to risk 2% of our account. So we want to only lose 2% if the trade doesn't work out. The stop loss distance, as we've measured, is going to be around 46 pips. And we're trading the currency pair euro-US dollar. We just have to enter the current price for the euro-US dollar. And then after we press calculate, you will see the results. So because we said we want to risk 2%, it shows that we want to risk 20 euro, which is correct. 2% from a $1,000 account, it's 20 euro. So worst case, if the trade doesn't work out, we are only losing 20 euro. So now comes the interesting part, the position size. So this tells us we need to risk and we need to have a trade with 4,590 units. But in Forex, it's much simpler than that. In Forex, we are working in terms of lots. So a standard lot is the typical unit and the typical measurement that we're using to enter our trades. Let me show you what this means. So we're back in MetaTrader. We click right here, trading, new order, and then you will see volume here. A standard lot would be like that, right? We have one standard lot that we would be trading if we now execute a trade. But to achieve the 2% position size, we only need to use 0.0459. So we have to use 0.0459, we round it up, 0.046. And because we only have 2 decimals here to work with in MetaTrader, we have to enter it like that. So it's going to be a little bit above 2%. Then we set our stop loss. The stop loss, as we said, is going to be here. It's 1.05101. And now let's click the buy trade. We want to get into the trade now. Of course, the price now has moved a little bit since I first measured it at the beginning, but it's going to be roughly the same. So we enter the trade. You can see here now we have the stop loss, and this is the buy order. You can also see at the bottom, we have an active trade now. We entered the trade at that time. It's a buy trade. This is the size, the euro. This is the price, the stop loss. And here you can see your floating profit. As the price is going up, we're going to make a little bit of profit. If the price will go down, we're going to make a little bit of a loss. What we can now do is we hover over our stop loss level here. And what we see is profit minus 23 and pips minus 48.6. So because the price has moved a little bit, it's not the 46 that we actually wanted, but it's fairly close. It's 48. And the profit minus 23 means that if the price is reaching here the stop loss level, the trade will be automatically closed by your broker platform and you're going to realize a loss of minus 23 euro. We wanted to have 20 euro, but because the market has moved a little bit and because we had to round using here the Forex lots, it's not going to be as exact as when you do it yourself, much faster. But this is how you execute a trade. And this is how you also then calculate your position size. If this didn't make a lot of sense, make sure to rewatch the video and rewatch this section. It's very simple actually once you do it yourself, but in the beginning you have to wrap your head around measuring the price differences in pips and also how to use the position sizing calculator and lots. The final piece to the puzzle and how to get started is you need to have a trading journal. At Tradeciety, we developed the edgewonk.com trading journal, which is the perfect fit for Forex traders. A trading journal is a place where you log all of your trades. You will have an overview of all of your trades. You can analyze them. You can find out what is working, what isn't working. And it's really important to have a trading journal. No matter which podcast you listen to or which book you read, you will always hear that a trading journal is the #1 tool that any trader will have. And by the way, you can connect your MetaTrader platform to Edgewonk to automatically sync all of your trades to Edgewonk in real time. Besides MetaTrader, we support dozens of other brokers and trading platforms to make it very easy to get your trades into Edgewonk. When you open Edgewonk, you will see that here's your profit calendar. It shows you every day for the month how many trades you have taken and the profit or the loss that you have generated. You will see your total net return, the win rate, the average profit per trade, and a lot of other very important metrics. For example, what is your most profitable week? What is the most profitable Forex pair that you are trading? When are you most profitable in a given day? So are you better trading in the mornings? Are you better trading in the afternoons? And that's very important when we come back to the trading sessions. Maybe your strategy and the patterns that you are trading perform better in the New York session compared to the Asian session. And by looking at the data, you can find that out. Edgewonk is very customizable. It's very easy to use. I have created a lot of videos that will walk you through the different features in Edgewonk, and you can then make your way around it. There are lots of ways how you can visualize and analyze your trading data to find very interesting patterns and to really get to the bottom of how to improve your trading, find out what's working, what isn't working, and how to turn that around. As a Tradeciety follower, you can use the discount code Tradeciety when you go to edgewonk.com and then buy your Edgewonk subscription. You will get a big discount on your Edgewonk subscription with the discount code Tradeciety. And now you're ready to tackle the Forex market. We have looked at price action candles, we have understood what Forex is, we have taken a look at different patterns, at trend analysis, we have taken a look at Forex market sessions, news events, we looked at MetaTrader, we have found out what pips and lots are, how to get into a trade, how to do position sizing, and we have looked into the Edgewonk trading journal. If you have any follow-up question, let me know in the video description below, and I'm very happy to help out. Or just come over into our free Discord and hang out with me and ask me questions there.